What if I told you the price tags you see at the grocery store aren't actually going up, but rather, your money itself is silently shrinking? What if the inflation crisis everyone's talking about isn't about rising costs, but about a fundamental, invisible decay in the value of the dollars sitting in your bank account? And what if, by 2026, this hidden financial force will have already restructured the landscape of your entire economic life, without you ever consciously realizing it? You felt it, right? The sting at the pump, the eye-watering bill for a basket of groceries that used to cost half as much, the way your rent keeps creeping up year after year. It feels like everything costs more, and your paycheck just isn't stretching as far as it used to. For many, 2026 might feel like just another year, a new page on the calendar. But beneath the surface, the slow, grinding gears of inflation are set to redefine what money even means for your daily life. It's not just some abstract economic concept debated by suits in fancy buildings, it's about the tangible things you buy, the goals you're saving for, and the quiet fear that your hard-earned cash is losing its fight against the rising tide. Your future vacation, your kid's college fund, that comfortable retirement you dream of, all of it is vulnerable to this silent erosion. This isn't about a market crash you can see coming, it's about the very ground you stand on slowly shifting beneath your feet, impacting your choices, your stress levels, and your freedom right now, and significantly more by 2026. Okay, let's peel back the curtain. Forget the fancy charts and economist jargon. Imagine money isn't just paper or numbers on a screen, but a universal coupon. Each coupon lets you claim a certain amount of stuff, a loaf of bread, an hour of a plumber's time, a new pair of shoes. Now, imagine a huge pizza party. There are only so many slices of pizza, right? That's the real stuff in the economy, the goods and services. Money is like the tickets you use to get those slices. If you have 100 people and 100 slices, each ticket gets you one slice. Simple. But what happens if suddenly, someone prints a whole bunch of extra tickets, and now there are 200 tickets, but still only 100 slices of pizza? Everyone still wants pizza, but now there are twice as many tickets chasing the same amount of slices. What happens? Each ticket is suddenly worth less pizza. The price of a slice, in terms of tickets, goes up. That's inflation. It's not that the pizza got more valuable, it's that your tickets got less valuable. By 2026, this more tickets, same pizzas scenario is likely to continue evolving. Why? Because the someone printing extra tickets often includes governments needing to fund big projects or manage debts, and central banks trying to stimulate the economy. When new money enters the system, it doesn't magically create more pizza. It just dilutes the value of all the existing tickets. And here's the kicker, this isn't a one-off event. It's a continuous process, a slow leak in the tire of your financial vehicle. We're talking about the cumulative effect of years of this dilution, where each year, your tickets just buy a little bit less. Here's the counterintuitive twist that 99% of people miss: inflation isn't just an economic phenomenon, it's often a hidden political and social tool. Think about it, imagine a country deep in debt. They could raise taxes, unpopular, cut spending, also unpopular, or they could let inflation do the work. By allowing the value of money to slowly erode, the real value of their debt also shrinks over time. It's a way for governments to pay back old debts with new, cheaper dollars, effectively taxing everyone who holds those dollars, without ever sending out a tax bill. It's a silent transfer of wealth. Did you know that the US dollar, since the creation of the Federal Reserve in 1913, has lost over 95% of its purchasing power? That means a dollar today buys you about 5 cents worth of what it would have bought you a century ago. That's not just random market forces, that's the slow, steady dilution in action. And did you know that during hyperinflation events, like in Weimar Germany in the 1920s, prices changed so rapidly that people were paid twice a day and raced to spend their wages before they became worthless? There are documented stories of people using wheelbarrows full of cash to buy a single loaf of bread, only for the price to increase by the time they reached the front of the line. While we're nowhere near Weimar Germany, the underlying mechanism, the erosion of money's value, is the same, just operating at different speeds. The inflation rate you hear on the news? That's an average. Your personal inflation rate, based on what you actually buy and how you spend your money, could be dramatically different, and often much higher, especially for essential goods like food and shelter. The illusion is that prices are going up. The reality is that the measurement unit, your money, is losing its ability to measure real value. It's like trying to weigh yourself on a scale where the kilogram unit is secretly getting lighter every year. You might think you're getting heavier, but maybe the scale is just messed up. So, what does this mean for you by 2026? It means you need to stop thinking of money as a static store of value, like a rock you put in your pocket. Instead, think of it as a dynamic, living thing, constantly influenced by forces beyond your control. The crucial shift isn't about finding specific things to buy or sell, but about fundamentally re-evaluating where you keep your wealth and how you define savings. If your money is just sitting idle, especially in low-interest savings accounts, it's not just not growing, it's actively shrinking in real terms. It's like leaving an ice cube out in the sun, expecting it to stay the same size. By 2026, the people who navigate this landscape best will be those who understand that money velocity, how quickly money moves and where it goes, is just as important as the quantity of money itself. They'll be thinking about how to ensure their time, skills, and resources are translating into real value that outpaces the erosion of currency. This might involve focusing on acquiring skills that are in high demand, understanding assets that traditionally hold their value better than mere cash, or simply being more intentional about converting depreciating currency into appreciating real value. It's about moving from a mindset of simply having money to a mindset of understanding its function and its flow. Don't just count your money, understand its purchasing power. If the very paper in your wallet and the digits in your bank account are merely a societal agreement about value, and that agreement is constantly shifting beneath your feet, what truly gives money its power, and how will you adapt your agreement with it by 2026?